Now, before I get into the financial year results, I probably should talk about this company for a little bit so you understand what this company actually does. Now, Cirrus Networks is a managed services and IT solutions provider. They have three main divisions where they generate revenue: enterprise product sales. Now, that part of their business generates the most revenue, but it is on really low margins. The other two areas that they do generate revenue: professional services, which includes stuff like IP consulting, and managed services. Both of those areas have way less revenue but have higher margins. So one thing you could look for in the future around this company is where they are growing their revenue. If they are growing their revenue in managed services and professional services, that would be a good thing in regards to the profit growth. So that could be interesting if you do like this company. Now to the financial results. Financial year 23 results for Cirrus Network. And this company, again, has over $100 million of revenue. And that actually was up 8% on last year. Gross margins up 14% to 14.3%. And straight away, if you compare the profit to revenue, you can see this company is existing on really low margins. In fact, gross margins are really low, profit margins are really low, and operating margins are really low. And that can be a problem if you do see revenue starting to go backwards. So the first thing I will look for in these type of businesses with really low margins is revenue growth. If that stops, time to get out of the company. So gross margins, 14.3%. That's up 14% on last year. So potentially they are expanding both their professional and managed services. Adjusted EBITDA up to 4.8 million. That's up 127% on last year. Cash flow from operations, they reported 5.4 million. I'm reporting 4.7 million because I take into account leases, but their cash flow from operations reported number of 5.4 million was up 80% on last year, which was 3 million. And maybe more importantly, well, maybe not more importantly, their net cash at the end of the financial year was $13.9 million. That's actually up 45%. So a lot of that operating cash flow is going down to the bottom line. In fact, the free cash flow for financial year 23 was $4.4 million. So keep some of these numbers in mind when we talk about the valuation of this company. I've already hinted at it. It's about $40 million, the market cap anyway. So if you like potential value and you love operating cash flow, free cash flow, you can see that the price operating cash flow and free cash flow of this company is less than 10. But not only that, this company has net cash of $13.9 million, which means the enterprise value of this company is more like 26 million, which means the EV to operating cash flow is more like 5. A few other metrics I do look at for every company I'm researching: return on equity, 9.7% for Cirrus Networks. I would prefer that to be above 10, but it is virtually 10, 9.7%. Return on invested capital, 11.4%. And again, I prefer that to be above 10%. Now, it's very important just not to look at 1 year's number. Have a look at the last 5 or 10 years of a company's return on equity and return on invested capital. And the thing I'm looking for is no discernible, consistent decrease in either of these numbers over the past 5 years at least. And Cirrus Networks does not have that problem. I've already mentioned this company is net cash by about 13.8 or 13.9 million. They have 930 million shares on issue. So at the share price right now is around about 4.3, 4.4 cents. So that means the market cap of this company is only $40 million. Now it's a valuation. I've already hinted, if you do take into account the enterprise value of this company, you can get some really interesting valuations, particularly the EV to operating cash flow, EV to free cash flow. P ratio is 23.5. And the main reason why P ratio is significantly higher than some of the other valuation metric ratios is because the profit is quite a bit lower than those. So one wasn't $1.7 million of profit with a market cap of about 40 million. That means the P ratio 23.5. So if you just looked at the P ratio 23.5, you would not say this company is cheap. You might not even say it's expensive, based off the growth this company has experienced over the past few years. Price to sales ratio 0.36. That is a function of the low margin quality of this business. In fact, I'd say this company is low quality because of the very low margins and the size of the company. And price to free cash flow 8.5. Now, that is way more attractive than the P ratio. And probably the problem this company has moving forward is whether they can maintain that sort of cash flow. If they can, more than likely profit will increase significantly over the next few years. Also did a reverse DCF based off the earnings per share. And what I'm looking for here is about 10 to 11% per year. And to achieve that sort of return, Cirrus Networks would have to grow their earnings per share at 14.8% per year. Definitely think they could achieve that. I wouldn't say it's an absolute certainty, but I think it's definitely doable for this company. Another thing I look for, or all companies I'm doing research, is growth in revenue per share, operating cash flow, profit, and the return a shareholder would have had if they've held on to the company over the past 10 years. Now, Cirrus Networks IPO'd on the ASX back in 2016. In fact, I think it was a backdoor listing, if I remember correctly. And back in 2016, there were a lot of backdoor listings on the ASX. But Cirrus Networks, the company, has been on the ASX since 2016, which means we only have an 8-year CAGR, or compound annual growth rate, in revenue per share, operating cash flow, profit, and the share price. Now, the first thing I always look at is revenue per share growth. Now, this company has increased the revenue from 19.5 million in 2016 to 112.2 million. But shares on issue have also increased. So if you do calculate the revenue per share increase, or CAGR, over the past 8 years, it's an impressive 17.7% per year. That's exactly what I'm looking for. Not only that, the company was loss-making and operating cash flow, free cash flow negative back in 2016, and it's turned things around. And now the company is operating cash flow positive, free cash flow positive, and also profitable. Share price hasn't really moved all that much, although it has increased 50% from 3 cents back in 2016 to 4.4 cents right now. Now, not including any dividends, that's a 4.9% return for shareholders over the last 5 years. And that 4.9% was per year. So this company has provided, just in share price appreciation, a 5% per year return for the shareholders. And that brings us to the daily chart. Actually, this is the weekly chart for Cirrus Networks from the time they IPO'd or backdoored on the ASX back in, according to this, it's middle of 2015. So I'm a little bit too late. I thought it was 2016. Anyway, the main thing you'll take away from this particular chart is really the share price of this company hasn't been in any significant uptrend, although you could argue it's developing to a bit of an uptrend right now. Now, there has been periods of time when there has been a little bit of hype in this company, and that hype dies away fairly quickly. And the best hype period for this company was back in early 2019. In fact, over a 4-month period, the share price of this company went from 1.6 cents to 6.2 cents. That's a nice 3-4 bagger over a very short period of time. But then over the next year, between say April 2019 to April 2020, share price went from 6.2 cents all the way back down to 1.4 cents. So it does seem like about 1.4, 1.6 over the past 8 years has been a good time to take a position in this company. And when the share price ever gets above, say, 4.5 cents, that could be a sign that you might see the shares sell off. We've seen that happen twice before in the past 8 years. Now, really interesting, the share price does look like it's trying to move into an uptrend. So there has been a renewed interest in this company over the past few weeks. And if you do take a look at the daily chart, which I won't show in this video, it does look a little bit more interesting than the weekly chart. That's all I have looking at Cirrus Networks financial year 23 results. This company has a market cap of $40 million, revenue greater than 100 million, and growing at a nice rate, 8% in the past year. And if this company can increase their margins, because it is already profitable, already generating positive cash flow in their operations and free cash flow as well, this company could be looking interesting. But beware, this is a low quality company without a moat, without a competitive advantage, with really low margins. So the one thing I am looking for in this company, in fact, there's two things. Two things I'm looking for in this company is the company able to maintain their revenue growth, and also I'd like to see some good growth in their managed services and also their professional services divisions, because those two have way better margins than the enterprise product, their reselling division. So if you have any thoughts of this company, if you are a shareholder of Cirrus Networks, love to hear your opinion on this company. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own specific needs. That's it for this video.